Julie?
Like a lot of funds, we have quite a small team for what is a large and diverse portfolio, and actually even diverse set of clients. So managers play a very important role for us, and we will continue to use managers. For us, it's important. We will continue to use managers as long as we get transparency, because we need to know our exposure. We have comfort that potential conflicts are being managed, and we're still getting access to stock. With respect to fees, I think it depends on, the smaller funds invest, our smaller clients, I should say, invest via funds, and our larger clients invest via mandates, which, we call direct, i.e. We own our assets, and the clients, the managers are just bringing assets to us or managing those assets. So for the smaller funds, they would generally pay higher fees because they are, given their size, historically need to go through a fund structure, whereas the larger clients, when they invest via mandates, can have a substantial savings on the fees that they pay. With respect to global, I think it's quite common. You go offshore and you're paying higher fees, and we have a lot of global managers that come and see us, and they always say the Australians are just quite so focused on fees. So we are, I think we are quite lucky here that, that we have quite an active investor base where we ensure that the fees are quite moderate compared to a global basis.
Good answer. It's certainly, as I travel globally, I mean, Australia's a very sophisticated market for its size. For those who don't know, we are the fourth biggest pension market in the world with a population of only 20 million, and that's as a result of, compulsory superannuation for many years. But as a result of that, we've had a whole lot of consolidation, which puts a lot more power into the hands of people sitting beside me. So obviously an outcome of that is more value for money. We've got some questions from the floor. It sort of was going to touch on my next question, but it's specific to a subsector. Is the aged care seniors living market an attractive investment proposition? And if it's not, why not? So we'll start with you, Brian.
I think one of the gentlemen on the panel before last, might have been David Harrison, summed it up really well, which is, on the face of it, the demographics, all of the investment theory behind the concept is good, and it's something, we've looked at from a high level, but we haven't found a model to tap into that yet that makes sense. And a lot of particularly in the seniors living market, a lot of the models we've seen from a high level through managers have been really built on the concept that resi markets are going to keep increasing in value, and you need that 4, 5, 6, 7% increase every year in order to make the product stack. And it's really hard, even though that has been the case in the past, it's really hard to underwrite that, and we certainly wouldn't in commercial and retail. So we're interested, and we continue to watch, but we haven't seen anything that we would invest in to date.
Christian?
We have actually had some past experience in that sector. I think the difficulty for superannuation funds is there's a number of aspects. In this sector, you're often competing against the not-for-profit charitable type of organisation. So it's a little harder for us to try and get the sort of returns that we're looking at, which compete against traditional property like commercial and retail. So I think that has been a factor. The other thing also is, particularly around aged care, having the right operators is really important, because there's reputational risk issues and so forth. So identifying and actually working with the right operators is another challenge. It's the same thing with some of the other areas that we actively try to look at, like affordable housing and so forth. And I think the third thing, as a superannuation fund, once you get to a certain size, you do look for investments that can scale, and often these sort of things, in order to really run well, you need to build quite a reasonable portfolio. So they have been the challenges in the past. I don't think there's anything fundamentally that we sort of disagree with, the concept of holding in the portfolio, but finding the right combination of things to have a practical way of investing that competes well against established forms of investment is probably the big challenge.
It seems aged care, childcare and agriculture have some similarities in the sense that, you know, the fundamentals make a lot of sense. And in the past they've also made sense, but also in the past the experiences have not been great. And I think that's part of what Bry's mentioned is the model we haven't got the right model yet, particularly for super funds. So I think it is on the horizon, but it's probably more of a long-term strategy and waiting to see if that model actually, you know, does work and for us.
There's another, smiling because I can see the question, there's another very good question. I was going to ask the question about the most attractive property sectors going forward, but we'll get to that. This one's quite interesting. What's the biggest dud investment your funds have made in the last 5 years? And of course, you wouldn't have been involved in those, I'm sure, so you could talk about those other people that made those dud investments. So let's start with you, Bri. I know you wouldn't have made any of these, but is there anything you want to admit?
Really, I guess not so much dud investment, but I guess the investments that we have had the most issue with have been and generally I think just for us, for the type of fund we find this to be very difficult. They're the sort of closed-end opportunistic funds that charge, you know, fees on committed investments. They have your set 10, 12-year life, and you have your investment period, et cetera, and for a fund that's doubling every 5 years, you get into a position with those types of funds, even though some of them are very good, and in some markets, particularly emerging markets, it's really the only way you can get access to decent managers. You get into a vicious cycle where you never get out of the J-curve because you're just constantly having to throw money into these investments because you're getting money back at the back end. And you're constantly, you know, with a fairly immature portfolio for that reason. So for us, they're tricky, difficult investments for us.
Change order. Julie?
So a little bit similar. So global funds, closed-end opportunistic. So it's not just the fact that, you know, they become quite ambitious and the raising becomes large, but what we also saw is that line between property and private equity was blurred. So these real estate funds weren't necessarily investing in real estate.
Christian?
I'd say come back and ask me in the next 5 years because I'm not sure. I think everything's gone up in the last 5 years, but I will tell you the sort of things that have caused us problems have been a foray into international funds where you didn't really know the market very well and you didn't really know the partner that you're investing in. And I think one of the great things about property as an investor is, you know, things can go wrong, but if you've got the right person managing it, whether it's a manager or you're doing it yourself, that can actually address the issues and actively manage, I think there's a lot of value in that, which is a bit contrary to the fees thing. But a lot of these portfolios, you pay a lot of fees, so things go wrong and it feels like it's passively managed. So I think as a general rule, which is sort of a bit about the forward thinking, you're going to risk having more dud investments if you're investing in an area where you don't know the market, you don't have a trusted partner, and you don't have flexibility to respond to changing circumstances.
Just for everyone's benefit, Christian also, I'll reveal this about him, he was consulting, so he worked for a consultant, consulting to the fund now that he's the CIO of, so he was never going to admit 5 years ago there was a dud investment. Yeah, so I won't, I'll jump off this and ask the other question. So if they're the worst, let's look forward. What are you most excited about? What sector, what subsector, what currently where we are? We had a very good presentation on residential. It's noted that a lot of super funds of your size don't play residential. It's a massive market, but I don't want to steer that towards that answer. But what's the sector or the subsector that you're most interested in? Let's reverse it again, go back to you, Julie.
I think the most attractive opportunities for us are any sort of sector or assets that are leveraged to the increasing infrastructure investment. Firstly, and that's a shorter to medium term opportunity. Over the short term, I think probably value add type of strategies, B type assets in well located markets.
Christian?
We do have a bit of exposure to residential. Not so much the cheaper end, but the higher quality end. Residential is pretty hard to invest in because, again, it's this sort of scale thing. So we tend not to invest to hold. We tend to invest to develop and sell. And as a consequence, it does give you a little bit of flexibility in the sense that you're not investing for the long term. So if the pricing falls off and you've got pre-sales, assuming that the creditworthiness of the purchasers, which is probably potentially a risk, but it does give you a bit of control there. So we have seen that aspect of where we've been investing has been very successful, but I'm quite cautious about the forward-looking outlook. Again, I think having the capacity to modify your strategy is really important, and again with residential, the capacity to change your product in terms of what the market might be over time, I think that's also pretty important as well.
Brian?
Everyone seems to have commented on resi, so we don't have any resi in our portfolio, and we find it quite hard. I mean, multifamily, we've looked at a bit in the US, but probably by the time we were ready to look, the market had run. So it's exceedingly expensive, as is most of the US at the moment, in our opinion. In Australia, the resi deals are, as Christian was saying, so they're flips, and you're really looking to do pre-sales and then build and get out. For us, that's hard for two reasons. One, we're a taxpayer, so you're paying a fair bit of tax on that, for your members, and really it's a development play, so you're paying a revenue tax, not a capital tax, and also you're getting the money back, which is a good thing for that type of investment, but when you're doubling every 5 years, there has to be a fairly large portion of your focus which is on investments that are going to be a little bit longer term, so that you can continue to at least maintain your real estate target. Where we are spending a lot of time at the moment really is this sort of build the core concept. So probably we've got a little bit of development in Europe that we're doing, but it's mainly value add with the view that you're putting your faith in being able to deliver the returns more in the skills of your manager as asset management skills, rather than kind of going, gee, I hope that growth I just paid away, comes through. And to that end, we've been reasonably active in the UK, largely because even though the cap rates are low, there is sort of growth coming through, which we're reasonably confident underwriting. In the US, you're paying too much of that growth away, so we've just really struggled to be competitive there. Plus, there's a lot of tax issues in the US for an Australian investor, which makes it quite hard. And in Europe, we can't underwrite any growth, so it's very hard to make the returns kind of stack up.
But you raise a good point. I mean, you're all very large funds growing with mandatory contributions, and if you look at the Australian marketplace, you all know supply. You can't buy another Macquarie Centre, you can't buy, they're just not being built, and therefore to get the size of checks you need to get away when you're doubling every 5 years, so you'll be over 100 bill, you're going to be forced to look in different markets and offshore. So I know you touched on it, Brian. Let's go back to you, Julie, and say, okay, so where offshore and where, and what would you be looking for?
Firstly, I think I'd like to mention that T Corp's a bit different than a lot of the other funds that are doubling 5 years' time. It's actually each of the 3 clients are close to fully invested, and in fact the size of the funds will remain stable. Having said that, we do have exposure offshore. The opportunities at the moment seem to be more so in Japan. Seems quite interesting. It hasn't reached the pre-GFC levels. The US has had very strong returns over the past 3 years, and I think that will taper off, but yet the fundamentals are quite strong there. So we are looking at opportunities via our manager in Japan and the US, but in all cases they are very much asset-specific acquisitions.